I think there's a couple of reasons. Firstly, it's optimism that maybe we're moving closer and closer to some type of trade agreement, or at least a detente with China with respect to trade tension. So I think that's the first thing. I think secondarily, what's driving this move, if you unpack it, is really the move that we've seen in break-even inflation, particularly today. So you haven't seen a significant move higher in real yields, but you are seeing the market price in higher inflation. And I think part of that is being driven by the CPI number that came out earlier today, and then also by the accommodative policies through central banks, where the market is expecting that it is going to have some impact to rising inflation. The one thing, I would note, and certainly other speakers this morning have noted as well, is that I think it's a little bit of a fool's errand to think that we're going to get close to the 2% inflation level, but getting a little bit higher in terms of versus what the market's pricing in right now is what I think the market is getting a little bit excited about, which is why you're seeing inflation, why you're seeing nominal yields rise.
Stephanie, going back to industrials for a moment, between some of the comments we've gotten today from the Morgan Stanley conference, what we've heard from some of these companies in general more recently, do you still like names in the space? Are you still bullish on them? And I guess what would be a warning sign to you?
Well, I think, yes, I do still like industrials. A lot of it is valuation. A lot of it is that they've lagged so substantially in the last 2 quarters. And I think expectations are already set in the stock's prices that earnings are coming down. Whether they're coming down 5%, 10%, some people think it's even more than that. But I think the valuations are expecting a lot of that. If you have good exposure in aerospace and defense, I like that sector very much. I like housing as an end market. I still even like non-resi and resi construction. Even though it's come down, you still have a lot of these indicators, these sentiment indicators, like the Dodge index, above 50, and that's expansionary. So, okay, it's down from 57 to 50, but I still think that these companies are going to be able to put up some good numbers, and they're very good on the margin side. And I think that they will continue because a lot of them have already restructured and also have taken pricing. So I like some self-help stories. United Technologies, as you mentioned, because of the spins that they're going to be doing, and also the Raytheon acquisition. I like Stanley Black & Decker. They've already taken a whole bunch of pricing. And I still like GE because I think it's a turnaround story over the next 2 or 3 years.
Erin, the rotation we'd seen at the start of the week has paused today, but you still like value. You still like dividend stocks. Is that right?
I like dividend stocks, not value. I actually continue to like growth relative to value at this point in the cycle. Our view is that growth is going to continue to decline in the U.S. and that, despite the, positive stimulus effects that you may see from the Fed and, despite certainly some temporary peace or temporary sort of agreement on a trade deal, we don't think it's going to be a meaningful trade deal that's really going to start to reignite stimulus in the U.S. economy. So as a result of that, we think that growth is going to continue to move lower. At that point in the market, when growth is slowing and still quite low, you want to own growth. You want to own the secular companies that can do well in absence of a high GDP environment. So I like the tech sector still, and I would be buying software and services right now, which is sold off and underperformed over the last couple of weeks. I would also be looking at the dividend yielding stocks like utilities. I think REITs also offer value, and I like the sort of U.S. housing market as an end market as well. But I would be barbelling the portfolio, staying away from value, buying secular growth, and buying dividends.